where, as I mentioned earlier, we're really in the deep throes of addiction to liquidity, to debt, to money printing, quantitative easing, low interest rates. We're kind of got an economy that's just geared towards all that. And I think we need a straw to kind of break the camel's back to maybe create this sort of a crisis situation. And I think the straw that could do that would be the bankruptcy of the entitlement programs in the United States around 2027, 2028.
On this episode of What the Finance Podcast, I have the pleasure of welcoming on Mel Mattison for the first time. So Mel is a writer and financial services veteran with 20 years of experience in the realm of high finance. So Mel, thanks so much for coming on the podcast today.
Thanks for having me, Anthony. Happy to be here.
No problem. I'm looking forward to the conversation. As I was saying before, I've really enjoyed your recent interviews on Blockworks and a few other platforms. So I thought I'd sort of bring you on to, I guess, expand on sort of what you said there. So my first question is, what is your current outlook on what you're seeing in, I guess, the macro and markets currently?
Yeah, I think we're in an interesting time here. I tend to, when I'm looking at things, look at broader, bigger picture, longer term trends, follow things, antiquated things that I think are still important, like the money supply. And my work showed that really we had kind of a peak in the money supply back in like October of 2022 or so. And then after such a massive explosion, things started trickling down a little bit, and M2 went down by about $1.5 trillion and kind of bottomed around October, November of last year and started resuming its uptrend. And so to me, I'm not really surprised that we've seen a little bit of a slowdown in things like the labor market, that we've seen inflation come in a bit. I think it's coinciding with about a 1-year lag from these money supply peaks and valleys. And I tend to look at something the Atlanta Fed puts out called the sticky price CPI, where they try to focus on those items in the CPI calculation that tend to be more sticky, the things that don't move around as much and aren't as volatile, more so than just, for example, cutting out food and energy. So it's a little more sticky than core. And I think that what you've seen is about a year after these events happened, so about a year after the money supply peaked, we had the peak in sticky CPI. And I think we saw that bottoming out in the money supply about a year ago, or it will be a year in the October, November range. And we're going to start seeing resume strength in the economy, a result of the liquidity, the growth in the money supply, starting to funneling through on that 12-month lag in the end of the fall, heading into 2025. So I think what the market is really concerned about right now, that we're on our way to a recession, which the market has been concerned about for it seems like years now. This recession that never comes, and thinking that inflation, the dragon has been slayed, and we're in the clear on that, and we need to start doing 50 points every meeting and really get those rates down. I think that's misguided. I think if you look at the Atlanta GDP now, we're running like around 2.5% for Q3 GDP. I think that a lot of the numbers that come out in payroll reports are really affected by immigration flows. And I think, the best coincident indicator on the labor market is probably initial jobless claims, comes out on a weekly basis. And for that to really be falling off a cliff, we haven't seen anything like that. We've seen some volatility in those numbers, but nothing that indicates to me like we're on the verge of a massive recession. So I think what we're seeing right now in the markets is essentially a correction. We're seeing people maybe rethink where they want to position capital around the edges. Do they want to move a little out of high tech and go a little more into, say, mid caps? Do they want to look a little more at emerging markets rather than US? I think those types of decisions are what the market is kind of grappling with now. But in the end, we're going to come back to 2025. We're going to have inflation start to come back a little bit. We're going to have nominal GDP growth continue. And I think ultimately we're also going to have equity prices move higher. And I think we're also going to have bond prices move lower, yields moving higher. I think that we're in a little bit of a range on things like the 10-year, but I don't think it's going to wind up going dramatically lower from here. And so I think for equity investors, we're in a pretty good spot. For bond investors, I wouldn't be buying 10 years with both hands right now. I think yields are not going to go too much lower, and they have potential to go higher.
Okay, thanks for laying that out. So you sort of buy into the notion that we'll have higher inflation for longer, or I guess at least for the next year or two. Is that sort of what you're seeing?
Yeah, I actually think multiple years. I think maybe even a decade or so. I think that, and I think maybe just taking a little bit of a step back, because as I mentioned, I do kind of come at this from more of a broader, longer term trends. And so, I could take this, way back, but let's just go back to 1944. So that's 80 years ago, in July, was the Bretton Woods Conference, when, the United States was essentially installed as the global reserve currency. For people that are, economists, they might be familiar with something called Trippin's dilemma. And basically what it is it's basically a fact that if you're going to have a single country's currency be the world's reserve currency, the world is going to have a demand, in this case for dollars. And really the only way to satisfy that demand is going to be through the creation of enormous amounts of debt. And so the die was really cast 80 years ago that the United States was going to start going down this deep debt spiral path. And it's taken a long, long time for some of those chickens to start to come home to roost. But I think we're on the verge of starting to see some of the real massive impacts. That said, we have seen very significant impacts happen slowly over the decades. And I think the number one impact is that we went from manufacturing things and exporting things to exporting our debt. And so we hollowed out our industrial base. We essentially became the world's exporters of debt, i.e., we were exporting dollars so that the world would have enough currencies for all of their, inter-country transactions. And that demand for dollars has been seemingly insatiable. But I do believe that there is kind of a functional limit on that. And I think that what's happened is we've also gotten ourselves simultaneously addicted to the cure for any recession or any type of economic downturn is pumping mass amounts of liquidity in the system, whether that's through expansion of the Fed balance sheet, enormous fiscal spending, what have you. And while we were in a situation, for example, in the 1980s, when we had inflation, we were able to raise rates really high and we could handle that for a sustained period because debt to GDP was, 30, 40%. Now, when we're in a situation where we're at the highest debt to GDP levels, we're surpassing where we were at World War II. The United States government simply cannot sustain higher interest rates for long periods of time, given the net interest expense that the government will have to outlay. And we've already seen this year, I follow all the monthly statements by the Treasury Department showing, what they're spending on Medicare, what they're spending on Social Security, what they're spending on net interest expense. And net interest expense is now the biggest single functional outlay of the United States government after Social Security. It's bigger than defense. It's bigger than Medicare. We simply, if we had 7, 8, 9% rates that we were paying at our debt load, we'd have all of our tax receipts simply going to net interest expense. And so we cannot have that happen. And so functionally, that creates different imperatives. And one of those imperatives is that yields cannot get too high. When we had the 10-year starting to approach 5%, or actually kiss 5%, a year or two ago, we saw markets in free fall. We had the dollar high. We had the Dixie index around 114. It's around 101 now. Since then, when we've had this equity run up since like the fall of 2023, is basically, we've had the dollar come in, we've had interest rates come down. And so the economy has been, humming along. But ultimately, the fiscal demands, the entitlement demands, the fact that we are at full employment and we still are running deficits, annual deficits of 6-7% of GDP, simply mean that going forward, there's just going to be more and more treasury debt issuance that has to happen. And this will inevitably increase the money supply. And as I mentioned, in the beginning, I tend to follow some of these old school indicators like money supply M2 in particular. And I believe that we are going to continue to expand that, especially if any sort of an economic slowdown comes. The only solution the government is going to have is going to be to produce liquidity, because if they don't, the stock market's going to crash, tax receipts are going to crash, entitlement spending and social welfare program spending will explode, and we'll be in an even worse situation. So we're basically at a point where a significant and long recession is almost fiscally impossible at this point. And the lesser of two evils will be, do we print more money and create more inflation, or do we let the whole system collapse? And I think they're going to choose the former. And so I think what we're in for is a prolonged period of inflation. It will be bumpy. Some years it might be 3%. Some years it might be 5 or 6. Some years it might be 7 again. Some years it might be 2.5, but that we're going to need to essentially inflate our way out of this debt while we try to find a solution, if at all possible, to these long-term structural problems in our debt and our entitlement programs. And I think there's also the potential that we don't find a solution and we come into some sort of catastrophic, debt dollar spiral decline that is essentially necessitates a Bretton Woods 2.0 global reset. Now, I don't know if that's a necessity of occurring or if this can be managed, but I think either way, inflation is on the horizon for some time to come.
Yeah, okay. Thanks for explaining that. There's a lot to unpack there, and I appreciate the depth you've gone into it. So I guess there might be lots of people saying, it's potential for, no, not that anyone's talking about deficit reduction, but maybe if they found a way to even reduce it down to, 4 or 3% deficit, you have that little bit of inflation at 3%, your growth is still at a similar level where it is. There's sort of that pathway where they could do that, and then everything might be okay. Do you see that being possible?
Mm-hmm.
Or is that just maybe preventing the inevitable?
Yeah, I think there could be an extremely narrow, extremely tight pathway where we don't see, let's say, very super significant inflation for like a 10-year period, like I've laid out. I think it would have to be this absolutely perfect mix of, say, productivity growth enhancements from things like AI, massive reductions in the amount of, for example, cost of healthcare, that would help with Medicare entitlement spending in the U.S. and other health programs around the world and other developed economies. I think that pathway, though, is actually very unlikely. That if I was doing a scenario analysis, I might put a 5% chance, maybe if I was being generous, a 10% chance that the stars are all going to align, and that's ultimately how it's going to happen. And I think that the more likely scenario, the base case scenario, is really that with turbulence, with volatility, with sustained higher than 2% inflation, we somehow muddle through and manage through this period. But by the end of it, the global monetary system looks very different than it does today. This gets into other tangents and things such as the BRICS countries and what they're doing, and the reduction of treasury as a reserve asset on the balance sheets of central banks around the world. But I think we're in this process of kind of extricating the U.S. dollar and the United States from the massive dominating position that it's been in. And this has been going on since World War II. At the end of World War II, the United States economy was over 50% of global GDP. Now it's 20%, less than 20%, something in that neighborhood. So we have been reducing this global importance from an economic standpoint, but we haven't from a monetary standpoint. And I think the economic and the monetary need to get a little bit more in line, where the U.S. dollar and the Fed providing dollar liquidity and all the things that go into us being the reserve currency, the United States, that is, need to be more aligned with the reality of the economic situation that the world faces. And so I think that's really the more likely situation, and that's going to be a massive change, and it's going to have political ramifications. And I think we're seeing discussions about things like tariffs and things that used to be, considered, anathema to people, understanding that the United States needs to rebuild its industrial base. The United States needs to get some sort of manufacturing back. We need to start building some things again. And so I think the global economy is really in for a period of massive change. That doesn't mean it necessarily needs to be a complete disaster with everybody on the street and 25% unemployment. But I do think that's a small possibility as well. But I think what's the most likely scenario is this prolonged period of inflation while the globe realigns monetary and financial mechanics to the actual economics of the way the planet is functioning.
Okay, and then if we look at, I guess, in the next few years, you've mentioned that you think at least in 2025 it's going to be very positive for the markets as growth and sort of that this small piece of inflation comes along. How long do you think that's going to last? I think I've heard you say somewhere 2027 is where you think it's sort of a likely place where it might blow up.
Yeah, so in that bear case, worst case scenario where we have some sort of a real crisis and collapse, I have forecast that the most likely time period for that to happen is somewhere in the 2027, 2028 time range. And the reason why I'm specific on that range does have to do with the United States entitlement programs, which, for non-U.S. listeners, there's two main ones. There's Social Security and Medicare. Also, we have something called Medicaid, which is health insurance for disabled or low-income people, Medicare for elderly people, and Social Security is income for elderly people. And those have traditionally been paid for through payroll taxes. And we have had enough growth in employment that the payroll tax money that comes into Social Security and Medicare have been able to cover the expenses because we had more people working and we had less people collecting these entitlements. That changed around 2020. So around 2020, for the first time in decades, we had less money coming into Social Security than we were paying out. And we began depleting the trust fund. It's called the Social Security Trust Fund. It's orchestrated by the Treasury. It holds, I believe it's around $2 trillion right now in debt. So it's not like cash sitting there in a lockbox, but it holds these special securities issued by the Treasury that only the Social Security Trust Fund is able to buy, but they're essentially treasuries. And so they're holding this money, and that's now being depleted. And what this trust fund has enabled is it's enabled two things. One, when we were taking in more money than we were spending, you had basically a natural buyer of Treasury debt. And so the Treasury could sell securities to the Social Security Trust Fund and then use that money to fund operations. Now we're in a period where the trust fund is being depleted to pay that. But around 27, 28, 29, that trust fund is going to be depleted. So now we're going to go to a point where, what do we do? Do we have the Treasury simply start paying out for these entitlements, which, for example, would probably double the deficit as a percentage of GDP. If we were at a 5 or 6% deficit to GDP on an annual basis, we could be moving to a 10, 12% easily. And it will happen, in an instant. The second that last dollar gets paid out from the Social Security Trust Fund and it's now bankrupt, now the entire shortfall needs to be made up by the Treasury. And the shortfall is going to be that difference between what are we taking in from payroll taxes and what amount of benefits do we have to pay out. Right now, that shortfall is being covered by the trust fund. And so all of these things are starting to come to a head, where you also have this situation post-COVID, where, as I mentioned earlier, we're really in the deep throes of addiction to liquidity, to debt, to money printing, quantitative easing, low interest rates. We're kind of got an economy that's just geared towards all that. And I think we need a straw to kind of break the camel's back to maybe create this sort of a crisis situation. And I think the straw that could do that would be the bankruptcy of the entitlement programs in the United States around 2027, 2028.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. You know, I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Okay, thanks for explaining that. So the Social Security, so money that's sort of put into that, is that just exclusively invested into treasuries or other sort of low risk fixed income debt? Do you think there's a possibility that, I know lots of private funds, they have been highly invested in equities and sort of other higher risk assets? Do you think that's a way out of it, or is it too late for that change?
Well, I mean, that's interesting. I mean, perhaps earlier that would be a way out. I think there are issues with that. So yes, it is exclusively in these special treasuries. So that it's a special type of a bond, has a special name, and only Social Security Administration, intergovernmental agencies are able to buy it. But it's treasury debt. They don't invest in equities or other things. It has been floated around that we would essentially, convert some of that, or change so that some of the payroll is going into equities. I think what's happening, and I think this ties into why the equity market really has not had a prolonged period of decline, since the financial crisis. I mean, we had a 50% drawdown like in COVID, but it was like a V. It went down, it went up. I think part of it is because the equity market is not doing what the equity market used to do. The equity market used to be a way for people to look at companies, evaluate what are their earnings, and put what they feel is an appropriate multiple on those earnings, and then purchase them. And so traditionally we saw, say, the S&P 500, would trade in the ballpark of a 15 times price to earnings ratio. A lot of times you might hear commentators on the financial news network say, the market's trading at 20 times or 21 times. It's very rich. I think all those old rules of thumb are just out the window. The market is valuations are not what really is driving the markets. What's driving the market is the flows of funds. It's the money that's constantly moving in to these markets. It's constantly moving in because we have switched over from companies providing pensions for their employees to everybody essentially being told the only way you're going to retire is if you start putting 5-10% of every paycheck into the S&P 500. And so everybody believes that, in the long run, stocks are going to do great, and that they're going to follow the Warren Buffett philosophy, and this is going to be, a way that they're going to get to the magical world of retirement. And I think what's scary is that that's not necessarily the case, right? So when we had a massive decline in 1929, right, the Great Depression, I believe it was either 14 or 24 years. I mean, it was some extremely long period before we got back to, I think it was 14 years before the Dow at the time was the major index people followed back then, before the Dow made new highs. So we had a 15-year period with no nominal return. And it even had a worse real return because there was inflation during that time period, right? Gold got revalued from $20 an ounce to $35 an ounce. So we had massive inflation. Stock market did nothing. In real terms, it was multi-decades before the stock market provided a return. And I think there's this belief now that that's impossible to happen. And I think that it's not impossible. And what I mean is there could be a 10, 20-year period where the return on equities in real terms is negative. And that just screws up everybody's retirement, screws up so I think for people to suggest that as a panacea to the retirement problem is we're just going to throw more money into the equity markets. You can do that, but you're now just 100% completely divorcing the equity markets from anything remotely close to what they were designed to be, which is a pricing mechanism for corporate securities. Then it just becomes this kind of Ponzi scheme where more and more money is, and in a sense, unfortunately, I believe our equity markets are acting more or less as a gigantic Ponzi scheme.
Thing, because I think, if you have all these, the more funds that are in there, and then I guess that's why we're seeing these flash crashes that we've seen previously, because people sort of get really worried, and then there's just this massive withdrawals of funds, and it's becoming definitely more volatile, I think.
Mm-hmm. Oh, definitely. And I think it's also becoming a lot more divorced from the reality of what is considered an appropriate valuation. I think you had a guest on, Lynn Alden, a few episodes ago. She was talking about Costco trading at 50 times earnings. 30, 40 years ago, a stock like Costco just would never trade at 50 times earnings, no matter what the macro environment was saying. And so I think that what we're seeing is we're seeing this perpetual increase in what market participants are willing to pay on a PE type ratio for equities, and that the old rule of thumb of 15 being normal, I think now it's at least 20 is normal. And that a high PE ratio where things are maybe expensive right now would be like 28, 29 times on forward earnings for the S&P, which we're not at. And so I do think that there's a potential for equity markets to go higher. And I think, the two things driving that are, one, this just built-in flow of funds where you just have this massive injection of buyers on a constant nonstop basis because of payroll deductions. But you're also seeing a lot of people that don't want to sell. They don't want to pay the taxes. You have baby boomers who might have these equity positions in things like Apple or Google that are up, 1,000% from when they bought it. And they know that they might not have that much time left on this planet. And when they die, their estate is going to get a step up in basis. And so capital gains will never have to be paid on those taxes. So they're like, how can I sell my Apple or my Google and have to pay these capital gains? I could be dead in 3, 4, 5, 7 years and my estate won't have to pay a dime. So they're just holding. They're buying into this belief of you just hold forever and everything's going to be okay. And then you're getting, the algos coming in and also moving the prices around very quickly, causing volatility. But the fundamental thing you have is you have, automatic buying, index buying, where people aren't really looking deeply at these individual issues. And then you have the fact that people are holding because they just think in the long run it's always going to go up, and I don't want to realize the capital gain taxes. And then the sophisticated investors, I think, are sitting back and they're understanding these patterns. They're understanding these are the mechanics of the market that we're operating in now. And so they're piggybacking on top of that. And they're also seeing a little bit of what I'm seeing, which is this massive debt issuance that's coming down the road, these fiscal crises that are coming around entitlements that are likely going to lead to more money printing and inflationary pressures. And in the long run, inflation is good for stocks, right? An inflation shock is not good for stocks. But in the long run, stocks are priced nominally. We don't do a real PE and a nominal PE. It's just what's the price to the actual earnings. And if the earnings margins stay the same, but the input prices and the sales prices go up in nominal terms, equity values can go up. And so I think we can see a nominal rise in the equity markets over these years. But I'm also a little skeptical of, are we going to see a real rise? And I think what we've seen this year is we've seen gold, for example, outperforming the S&P. And I think what that's saying is that, yeah, stocks are keeping pace with money supply and inflation and kind of nominal earnings growth. But if you look at, how many ounces of gold would the S&P buy you, it's less. I think if you go back 50 years, it took about 2.25 ounces of gold to buy the S&P. Now you take 2.25 ounces of gold, it still buys you the S&P. So gold is the mechanism in the marketplace that's essentially showing that this is all a lot of financial fluff, that these equity prices going to new highs and what's going on here. This is a result of inflation, of monetary policies, of nominal earnings growth. And we're not seeing a lot of real organic, true old-fashioned growth in the economy. And I think we're going to need to see that ultimately to get us to the other end of this, but it's going to be painful until we get there.
Yep. Okay. So in the near term, would you? I know some people have mentioned, the chance of like a melt up, where all these scenarios, there's so much, I guess, money going into the economy and into the system that's just going to, a few of the trends you mentioned there, people not selling, this passive money continuing to come in. Is that something that you see, I guess, in the coming years?
Yes, and when I use the term is going to be painful, I wasn't meaning painful for equity investors. I was meaning painful for the average person who has to pay their heating bill, who has to, fuel up their car every week with petrol. So what's happening is we're getting more and more of this income inequality, and the financial assets continue to rise. Things like homes, land, gold, silver, equities. These are continuing to rise, and so the haves are really not having a big problem with this type of a situation of inflation driving up financial assets, increasing their wealth. The problem is for people without these financial assets is that their real wages are not keeping up with inflation, and that the inflation numbers are grossly underreported. So you look at something like, people quote like CPI is up, say 22% since, say, Joe Biden became the president. But then you look at, well, what's a home price up since then? It's like 40%. So if the biggest items that people need to live a fulfilling life are up 40%, it doesn't really matter what the Bureau, I was going to say Bureau of Labor Statistics, but the government agency that puts out CPI, it doesn't matter what they're telling you the CPI is. What matters is how much does it cost to feed my family, heat my home, drive a car, buy a house, or pay my rent, or all of those things. And those are up much more than 22% over the last 4 years. So what's happening is it's painful for the people without it. And that's causing social issues, social unrest, likely also to increase in coming years as this differentiation continues to happen. In the meantime, the equity markets, I believe, will just continue going on their merry way because, again, they're getting fed. The beast is getting fed by these payroll deductions. The inflationary environment is driving up earnings. And so other investors are seeing these mechanics at work, and they're piggybacking on this. And I think, how this is all going to get resolved ultimately is really the big $64,000 question. And that's where I say it could be this narrow 5% path where we have this productivity miracle and this healthcare miracle, and we somehow get through it and things start returning to more of a normalcy. Or there's the other like 5-10% path where there's really like a cataclysmic clash, like a treasury auction fails. All of a sudden 10-year yields spike from 3.5 or 4% to 7 or 8% in a matter of like 2-3 months. The financial system goes into disarray. There's bank rubs. There's a dollar collapse, something that makes the great financial crisis look like a walk through the park. That's also the possibility. What I think is the more likely possibility is that certain, what I call deep economic state actors, people like the Federal Reserve, people like the European Central Bank, the Bank for International Settlements, the Treasury departments and finance ministers of the world, they're going to orchestrate or attempt to orchestrate some sort of a managed global decline in currencies. This is going to be great for things like gold. It's going to inflate away in real terms the global sovereign debt bubble, but it is going, the price that the piper is going to have to be paid is this, longer period of more sustained inflation that I talked about at the beginning of the show, that we're not going back to 2% inflation for the next 15 years.
Okay, a lot to unpack there, and I think that's the story of the whole interview. But then if I go to the dollar, so you mentioned there that it could depreciate quite a lot, going off sort of the world currency, maybe the need for a Bretton Woods 2.0. But I feel like in the near term, that's something that could actually strengthen, during this period where you have these, yield increases. So it seems like that would be, lots of pain for the rest of the world as well until there is that shift, like we've seen sort of the past few years. So then, do you think there's sort of a similar period where it could be, the US just outperforms because the US denominated debt is just absolutely destroying the rest of the world?
Well, I don't think we're going to see significant or meaningful yield increases. I think that we would if we were operating in a free market economy. But I think we're operating in an economy where, especially something like the U.S. Treasury yield, is just too important to be left to the market in the eyes of people like Jerome Powell and Janet Yellen. I think that the Treasury Department, in collusion with the Federal Reserve, is managing the Treasury yields. They're doing that in various ways. They're issuing a lot more bills. They're keeping the supply of things like longer term treasuries, 10 years, 30 years, lower than it otherwise would be. We've seen the Fed slowly and a little bit reducing its balance sheet, but they've also told the market that they plan on, essentially increasing as a percentage of their balance sheet treasuries relative to agency-backed securities, meaning mortgage-backed securities. And you're seeing a very wide spread between mortgages and treasury rates. That's kind of a whole another discussion about the manipulation of the yield curve. George Robertson is somebody who talks about this a lot, where he's looked at the typical spread between, say, the 10-year and the 10-year treasury and the 30-year mortgage in the United States, and that spread essentially has blown out in the last 2 years. It's much wider than it traditionally is, and it can't really be explained by, changes in prepayment risk or things of that nature. I think it has to do with manipulation of the yield curve and of the Treasury market. And so I think what we're going to see is we also saw, around the time of the financial crisis, that the Federal Reserve began paying interest on reserves to banks so that banks could hold treasuries, deposit them with the Federal Reserve as reserve assets counting towards their reserve ratios, and get paid interest. In the past, they actually had to deposit these reserves, and the Fed did not pay interest on reserves. And so there's this collusion between central bankers, treasury departments, the big banks, the JP Morgans, the Morgan Stanleys, the Wells Fargos, the Bank of Americas of the world, that are keeping these yields artificially suppressed. And I think they know that they need to do that. They need to do that because otherwise the interest expense of the government is going to get out of hand. The economy, the price of borrowing will be too high. It will create a massive recession and slow down the economy. And so, we're following in the footsteps of I would say, Bank of Japan, which, as many people would be aware of, has a debt to GDP of over 200%, and the central bank itself owns 100% debt to GDP, or the equivalent of 100% of Japan's GDP on its balance sheet, right? So currently, the Federal Reserve balance sheet, I believe it's around 7-8 trillion now. I think it peaked around 9, and they took it down a little bit. U.S. GDP, let's say we're able to hit 40 trillion sometime soon. We're not even at a quarter of the central bank's balance sheet to GDP. And so I think we're going to have this sopping up of treasury issuance by both private banks that are going to be able to collect interest on it paid via the Federal Reserve, and we're going to have the Federal Reserve buying, quantitative easing resuming. We're also having more bill issuance. We're also seeing a big push into stable coins. There's been some recent stablecoin legislation put forward by Senators Loomis and Gillibrand, and stablecoins, of course, also buy T-bills. So they're buying they're buying U.S. government debt, right? So I think that there are plans being put in place so that the financial system can essentially sop up all of this massive issuance that's coming, and thereby, artificially reduce the treasury price, or the treasury yield, artificially increase the treasury price, through the stopping up of all of this excess issuance. And so the yield curve is not actually, in my opinion, really a great representation anymore. I think it's distorted and manipulated.
Okay. Yeah, really interesting. So I guess if we look at this scenario, as you said, post 2027, 2028, what are the assets then that you think will perform? Is it sort of gold and the precious metals and the real assets? It sounds like that's sort of where you're leaning to, because they've really been the ones that have benefited during such periods in the past.
Yeah, I mean there's like good, okay, and bad, and I think gold, silver, eventually, I think probably Bitcoin as well. Bitcoin right now, it really kind of trades a lot more like a risk asset, but if it truly becomes adopted in the manner in which it's meant to be as a type of store of value, I think it's fair to say it's going through a price discovery phase right now where it's being extremely volatile and it's more a trading vehicle, risk on, risk off type asset. But if it eventually becomes to act, I like to say, gold is what Bitcoin wants to be when it grows up. If Bitcoin can get to that gold status, I would lump Bitcoin in there as well. So gold, silver, Bitcoin, other commodities, real world commodities, things like oil, copper, zinc, nickel, farmland, real estate. Those are the assets that I think will do best. The ones that I think will do okay are ones that are kind of priced in nominal terms and not real terms, which is basically equity markets, right? And then the ones that I think are going to do bad are the ones that are really kind of credit. So I think bonds. If you're loaning money, and we're heading into an inflationary cycle, right? Inflation is good for debtors and bad for creditors. So I think you don't want to be holding the long end of the treasury curve. You don't want to be holding a bunch of 10 years or 20 years and thinking, oh, I better grab these at 3.8% right now because they're going to go back to 1.5. I think you're making a big mistake. And I think why we're seeing, by the way, these big swings in the treasury market is because the banks are just kind of these forced holders. The banks, the insurance companies, the central banks, they're buying these treasuries. They're just sitting there. But the marginal price is being moved around by short-term traders who are just like, okay, there's a weak jobs report. Therefore, possibility of a weak economy. Therefore, yields should go lower. Let me rush in and buy 10 years. And then, okay, no, now the initial claims came out stronger than expected. Let me sell it. And we're seeing these pretty big moves in very deep liquid markets, supposedly deep in liquid markets like treasuries. And I think that's a little, frightening, because this is supposed to be the bedrock of our financial and monetary system, the U.S. Treasury bond and bill and note. And it's just, it's trading, almost like emerging market debt sometimes. So I think what we're seeing is these are the initial signs that this whole post-Bretton Woods, dollar-based global currency monetary system, it's really getting rough around the edges, and it's kind of in its last innings here.
Great point. So Mel, thanks so much for your time today. Really appreciate it. Last question is, what is one message you'd like people to take away from our conversation?
I think just look very carefully at the assets and things that you're holding, especially if you're looking out for someone, maybe a parent who's elderly or someone, and they have a lot of their money in longer term bonds. I think, I'm not giving specific financial advice for any individual, but I think having a discussion with them or maybe a financial advisor would be worthwhile. For people that want to get a hold of me or message me, they can follow me on Twitter at Mel Mattison1. Go to my website, melmattison.com. And also, I have a financial thriller out called Quoz, Quoz, that covers a lot of these topics in a fictional format, corrupt central bankers, the blockchain, a lot of the topics that we touched on today. So if they're interested in that, I'd say check out Quoz. It's available pretty much wherever books or audiobooks are sold.
Yep, great. I'll put that in the description below. And yeah, I know we didn't even touch on a lot of those historical aspects about, I guess, the central bankers of central banks in Switzerland and what's happening there. So that was something that we'll have to save for the next conversation. But yeah, thanks again for your time.
Thank you. Appreciate it.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.